Okay, hello everybody, and welcome back to another Bentley Davey Tutors video. Yes, it is me again. We are back because there's more stuff for us to try and teach. So today's video will basically be covering all of the Year 9 Commerce curriculum. The Year 9 Commerce curriculum. I definitely didn't just forget that word. But basically, yeah, I will be going over a bunch of dot points from the curriculum, syllabus points, and I will just be taking a quick look at them. I'm going to try and make this video a bit shorter than they normally are because I have a bit of a habit for going on and dragging on for far too long. And it's good to just get a brief sort of understanding of what each of these things are. So that's sort of what I'm going to do. Like always, because the quality of production on these videos is incredibly low, I do have notes just there to the side. So if I'm looking over like that, it's because I'm taking a look at the notes. So if that's all we've got, we will get into it. Don't forget to like and subscribe if you do, and leave a comment. It is really nice when we get some likes and comments. I always make sure to read through them all. So yeah, it's really good. So if you could, that's always nice. But you don't have to. As you can see, I'm very sure of myself, which is really great for commerce. So we're going to start off these now. I'd better stop dragging on. Otherwise, this video will end up being 40 minutes. Anyway, so yeah, this is divided into a couple of different sections. We've got consumer and financial decisions, the economic and business environment, promoting and selling, and running a business. And that's where all of the things fall under. And the later ones are a lot longer, but that's all right. So firstly, consumer and financial decisions. So basically, the main statement for the start of the curriculum, which is speaking about like the scope of commerce and the concepts around commerce, the main statement that is at its core is consumers purchase goods and services to satisfy their needs and wants. However, wants are unlimited, but resources are scarce. That's pretty much it. That is the whole thing that they spend an awful lot of time teaching. Basically what it's saying, consumers or people who buy stuff, they buy things to satisfy their needs and wants, so to fulfill their needs and wants. And needs and wants are meant to be different things. Needs are obviously what you need, and wants are things that you don't need but you just want. And then the second part of the statement is a bit more important, which is wants are unlimited but resources are scarce. The main resource here is money for consumers, and for businesses it's actual resources. But the idea is people have an unlimited amount of things that they could want, but resources are too scarce, so they can't have all of that unless you're just like super rich, you're just bowling out. Then I guess you can. Yeah, so that's all there is for that point. Next point is about consumer protection, because apparently it's important to protect consumers from scams and things. So consumers are protected through a variety of measures. This is mostly in Australia. To make sure that they're pretty much not taken advantage of by big companies. And this mainly includes legislation like the Competition and Consumer Act from 2010, which basically stops businesses doing a bunch of dodgy stuff. And then also the investigative body of the ACCC, who's pretty cool. There was a show called The Checkout on a couple of years ago in Australia. They focused on the ACCC. It was very cool. They basically deal with all scams and misleading advertising and all that sort of thing.
You won't believe it, but guess who's back? It's voiceover Jez, everybody's favourite voiceover artist. Just here to apologise for how rubbish that last section was. I don't know, I just decided that I wanted to start doing anecdotes, which I'm sure really made it worse overall, but it's fine. I apologise. Now back to me maybe teaching something.
Okay, so that's all we've got really there in terms of consumer and financial decisions. Up next, I've got the economic and business environment. So, how this is going to work is the first dot point here is quite a big one. It's basically the nature of the economy. So what I'm going to look at is the circular flow of income and the business cycle. So firstly, we're going to start with the circular flow of income. Now what I'm going to do here is I'm going to put an image up of the circular flow of income somewhere, maybe here, probably in front of my face. That would be a service to all of you watching, because then you wouldn't have to look at me anymore. But yeah, I'll put it up somewhere, and then I will go through each part of it. So if I'm randomly pointing at an area where the image isn't, just ignore that and pretend that I'm pointing to the correct spot. So this is quite a complex diagram, but it's a lot easier to understand when I unpack it, hopefully. So we have 5 different sectors of the economy. Firstly, households and firms. So these are the two main ones. You can see they're in the center. I've pointed. I bet that's in the wrong spot. But anyway, so we've got households and firms. So how they work is households provide firms with the resource of labor. They provide firms with people to work there. And then firms provide back to households with money and wages to those people so that they can then spend it at the firms. So that one's pretty simple. Not that much happens there, but yeah, the income goes into there to the households. So as you can see above there, coming out of firms, we've got income, and going into firms from households, we've got consumption and expenditure, which is consumer spending. So consumers spend money at the firms, which gives the firms money, and they provide back with wages. However, there are 3 other branches. So those are the first 2. And a big principle that we're going to look at is injections versus leakages. So an injection is where money is put into the economy, and a leakage is where it goes out. And I'll explain more what those mean in terms of how the economy performs a bit later. So we now move on to the financial sector. This is all sorts of financial intermediaries, but the best example is banks. So banks are here. And so what goes in here, so the leakage here is savings. So when people put their money into bank accounts or into savings accounts, that means that they're not spending it. And so it's going out of the economy, and it's therefore a leakage. However, the injection that comes out of that is investments in businesses. So what banks do with the money that you deposit is they loan that out to other people. And the idea here is that firms loan money from banks to invest in themselves and to grow. And they can do this by hiring more work, which then puts the money back into the economy, or doing something like physically expanding, and then they have to pay other businesses to, say, build them a warehouse. But what you can see here is money goes out in terms of savings, but it also goes back in, because those savings are then invested by firms, and then that goes to wages, and then also to other firms, and then it goes to wages. So the idea of the circular flow is it goes just around and around and around. Then the next sector is the government sector. Once again, we have leakages and injections here. And the leakages for the government sector are taxes, because the government takes money, which again is not being spent. But the idea is it actually is being spent just by government spending on the other side. That's sort of things like building infrastructure for roads or transport, or any sort of things that governments decide to do. Not normally paying very high bonuses for corrupt political leaders. That shouldn't really be part of government spending, but that's all right. And yeah, so that's how those sorts of areas work. And once again, that government spending goes back into firms, and then back into households, and then around and around and around. Then the final sector is the overseas sector. This has 2 main, it's got a leakage and an injection like the other ones. The leakage is imports, as you can see over on the left, and the injection is exports. And basically, if you import something from overseas, your money is going out of the Australian economy, or to wherever you, or from wherever you are, to the country that you bought it from, which is why it's a leakage. But then an export is the complete opposite of that. Somebody from overseas is buying something from your country, and then the money comes in. So that's basically how that works there with the circular flow of income. So it's all tied around. However, there is a big thing here with GDP growth. So how GDP works is consumer spending. Actually, I'll start by explaining GDP. GDP is gross domestic product. So it's the sum of pretty much everything that the nation produces over the course of the financial year. So GDP is calculated with consumer spending plus investments plus government spending plus net exports, and that's the GDP. So net exports is exports minus imports. So you want that to be a positive number, obviously, because you want your GDP to be higher. And so that is the sum of everything produced within the country. But then this brings us on to the business cycle, which ties in quite well with this. The image will be somewhere on the screen once again. So how the business cycle works, you can see here, it basically explains different areas of economic growth or decline. So we can see here on the little wavy line, it's got peaks and troughs. A peak can also be known as a boom, and that's a very high point in the economy. And a trough can also be known as a recession or a depression if it's much lower. And as you can see there, that's a low point. And then we've got expansion, contraction, and expansion lines there, which just show whether the economy at that point was going up or going down. So how is this sort of worked out? Well, that's graphing, that there is graphing the GDP over time, and you want the GDP to be increasing. But the one other formula that is important to note is that if injections are greater than leakages, that's great, that's economic growth. But if injections are less than leakages, that's bad, that's economic decline. And that is sort of all that there is there for the differences there. So the next bullet point that we've got is speaking about the nature of markets within the economy. And so I'm going to talk about the price mechanism and the interaction of supply and demand. So firstly, the price mechanism is a means of calculating the ideal price to sell an item, like a good or service at, based on the market equilibrium. So you've got a supply curve and a demand curve. I would put an image in here, but my drawing skills are just so great. And so the point where they intersect is the market equilibrium. You've got quantity along the bottom, you've got price up the top, and that market equilibrium shows you what price and what quantity you should sell it at. And that is the point where it is most ideal for both consumers and businesses. As well as this, we've got the law of supply and demand. The law of supply states that as the price of a good increases, the quantity that a business will supply increases as well. This is because firms pretty much want to just make more money, which is fair enough, and therefore they can afford to produce more supply if people are paying more for it. The law of demand, however, states that as the price of a good increases, the quantity of that good demanded decreases, which is basically more people will want something if it costs $4 instead of $20. And then finally, the next dot point that we've got here is the interactions within the market and the importance of ethical decision making. This isn't a very important point, but basically businesses are expected to use ethical decision making and things such as CSR, which is corporate social responsibility, because they have a responsibility to provide services for the people that are the reason that they can actually exist. So that takes us on to the second to last different section of this video. And so what this one is talking about is promoting and selling. So firstly, the selling process is pretty much what this whole thing is. So I'll be running through the selling process. So I firstly said selling something is about targeting your customer, producing a product that your customer would actually want to buy, setting your prices correctly, and just persuading customers to buy. But then more in depth here, I've got a bunch of points as to how we can properly look at targeting customers to buy something that you want them to buy. Basically, in order to best divert resources that a business has in terms of advertising and marketing, they need to develop a target market. So there are three different types of marketing a product and three different types, therefore, of target markets. So there is mass marketing, market segmentation, and niche marketing. So mass marketing is something that pretty much gets marketed to everybody. This would be something like maybe Vegemite for just for an example, or bread, or something like that. That's marketed to absolutely everybody because lots and lots and lots of people want it. It's not just a specific group. However, the next form is something like market segmentation, which is very common and it's a good strategy. So this is basically where you segment the market into different groups and then market to one of them specifically. For example, a children's toy is not going to be marketed to adults. They're going to segment the market and market it to children. Finally, there is niche marketing, which is where you get a very small segment of the market and specifically market to them. This could be a product such as a $52,000 Mac Pro computer, because only a very small amount of people would actually be able to afford to buy that. And so therefore it's quite a niche market, but they know that they can divert all of their resources there, which is why it's good. So another thing that's really important with selling is promotion. So this is pretty much everything from advertising to something like coupons, and yeah, everything in between that. Basically, it's where you promote, like, I shouldn't be using the word in the definition, but it's where you promote a product, which can either be through incentivizing people to buy it or just making the product more known and making the benefits of it more known through something like an advertising campaign. We then have price, which is all about how you set your prices for a product to both make enough profit to be able to stay in existence as a business, but then also to get your customers to want to buy it. And there are three different ways that you set your price. These are competition-based, which is where you look at what your competition is doing and either undercut them or slightly go over them, but you can only really go over if you can provide to them some sort of reason why it's worth paying the extra money, which can be hard to do. The second option is market-based. This is quite similar, but it's basically the price mechanism where you use supply and demand to determine what you should set your price at. And then the final one is cost-based. This one is really common, specifically in areas like buying like wholesale goods and I think in food as well. This is basically where you get the cost to produce the good and you add a markup to that. And that markup is essentially your profit. And so that brings us to the end of the selling process. And then we are moving on to running a business. This is our final topic, and it's quite a big one. Like it is the biggest one, so that's why I've left it to the end. But yeah, so running a business. The first bullet point is about being an entrepreneur. It's basically asking what are some of the characteristics of an entrepreneur. This is pretty easy, and it's also pretty subjective. But you can say things like hardworking, desire to succeed, good communication skills, good planning, measured, all those sorts of things. Okay. So that one's, that's just a bit of a naff point, but the next one is planning for success, according to my notes here. So I'm going to speak about organizational structures. So there are 5 different organizational structures that we are going to look at, but I've skipped a little bit there that I shouldn't have. There are 2 things here which fall under that bullet point, which is organizational structures and debt financing. So firstly, on the point about organizational structures, there are 5 different types of organizational structures. These are sole trader, partnership, private company, public company, and incorporated association. So I'm going to walk through each of them and what they basically mean. So firstly, a sole trader. This is a business that is individually owned and started. It may have some employees, but only has one shareholder. A partnership is where there are 2 or more partners who hold shares and say in the business. These don't have to be equal, like it doesn't have to be 50-50 or 33-33-33 or anything like that, but their terms are always set out in a partnership agreement. Up next, you've got a private company, and so in this structure, there are multiple owners, normally up to about 50, but these owners are often known to the original starter of the company. So these people all hold shares and have a bit of a say, but they are often known to the original starter as opposed to just being some random person. And then fourthly, you've got the public companies. This is the biggest type, and it's sort of anything that you would find on a stock market. And this is where they sell their shares in their business to the public, and the original owner or starter of the business wouldn't know who these shareholders were, but it would normally have a major shareholder.
Just by the way, if anybody's concerned about all of the screaming in the background, don't worry, it's just my brother and sister being a pain. But it's fine. Everybody, good. If you were worried. Actually, you probably weren't worried. You're probably just more annoyed by the very loud noises in the background. Okay, bye.
Finally, there's this one which really isn't very common, but it is an incorporated association. This is pretty much going to be your charities or your local sports club, but it has a couple of rules that govern it. It's basically it can only trade in one state, and it is usually not for profit. Now, the final thing that we need to talk about here is incorporation versus non-incorporation. And so what we see is sole traders and partnerships are non-incorporated, whereas private, public, and incorporated associations are all incorporated. So firstly, what is incorporation? Well, incorporation is where a business properly becomes a company, and what it means is that the owner and the business now become separate entities. This means that the owner would not be entitled to pay debts after a business, say, collapses and has a bunch of debts left to pay. And also, the business continues after the owner is dead, which is something that's a bit interesting there. However, these cost far, far more to set up, which is their main caveat. Secondly, unincorporated, and these were sole traders and partnerships, and this is basically where the business and the owners are the same. They're basically one entity. And so if the business goes under, the owners are completely liable for any of the debts that the business still has to pay. As well as this, if with that random example that I've tossed in again, if the owner dies, the business pretty much dies with it unless they transfer ownership. However, these are much quicker and easier to set up, which is pretty much their main benefit. So the next thing that we needed to talk about was debt financing. There are 5, there's 5 different types of debt financing that we need to talk about. Firstly, owner's equity. This is really simple. It's pretty much just where the owners put in money that they already have into setting up the business. This would be like if I had $300,000 in savings and I'm like, okay, I'm going to put this into a business. Secondly, there's returned profits. This is a great one. This is really good for everybody. This is basically where the profits of the business are returned into the business and they're used as equity. Basically, it's really good because it means that there are no debt. There's no debt, and hopefully the idea is that hopefully the extra money that you've put back in will help you make even more money the next year. The third one is an overdraft. So this is a form of short-term debt financing, which is basically where a business negotiates with the bank that they are able to have like a credit card sort of thing where they can draw a lot of money, a certain amount of money based on the agreement, to be able to buy something before they actually have that money. And this is in line with the agreement. But yeah, in the agreement, the idea is that they will pay it back soon. So an example of this would be if a business had to buy a bunch of supplies to build a house before they had been paid by the person yet to build the house. Okay, so the fourth option is a mortgage. This is pretty common. It's a long-term form of loan used. It's money borrowed from the bank, usually a very large sum of money. And yeah, it's borrowed from the bank to pay for something that costs a lot, which could be something like a new office or a bunch of cars for the business. And this is also often secured by something like a house, which means that if they were not able to make payments on the loan, the bank could seize the house, which is a bit bad. And the final one, number 5, is debentures. So this is where public companies issue something called a debenture, which basically borrows money from members of the public with an agreement that a certain amount will be repaid back to them. It's normally the full amount that they paid plus a designated return at the end of a specified time. It's sort of like an investment in stock with a return that is already predetermined. However, you can never actually be sure that will work out. And sometimes there are some stories of people not getting any money back at all because the business fails. So that brings us to the end of that dot point. And our final dot point for to end off the video is maintaining financial records. I just need to talk about why that is important. So this is pretty obvious. It's important to maintain financial records because it's the only way that you can actually know that what you're doing as a business is either right or wrong, and it allows you to compare performance from year to year. This also allows a business to control its money in terms of inflows and outflows. This is the same for an individual. And so you can avoid spending money that you don't have. And this can be done in either a profit and loss, profit and loss statement, cash flow statement, or a balance sheet. Finally, financial records are a must for public companies as they legally have to disclose their financial records to the public in order to be listed on something like the ASX 200 stock exchange. It's also good for companies. They don't necessarily have to, but a lot of companies like to do financial records to show to their shareholders to assure them that the business is doing well. So that is all there is here in terms of commerce, the Year 9 curriculum. I hope I covered it all. If I didn't, obviously do your own research. But yeah, hope you enjoyed. If you did, leave a like, subscribe. Thank you, and goodbye.